Recording. Perfect. What I'd like to start with first is just to look at the agenda real quick to see if anybody has any additions to the agenda. Start off with any comments from Rep. Lindsay. Then we've got 2 presentations set up. And then in terms of business, I do want to discuss this concept of corporate and what was intended. It's going to be really important in terms of the scope of work. So I want to get that needs to be settled. And I'm sorry if I'm scrolling too fast, if this makes people nauseous. Final look at the scope of work to see if there's any other comments, questions before that's released. Then definitely really look at you guys for any additional speakers for future meetings. Any other comments you might have, and then look at the next meeting, which is scheduled for July 31st. Currently, I've got 1 speaker set up with CoreLogic. They're kind of the data aggregator. So when people are doing a lot of this research, that's who they're using. They've been studying corporate ownership as well. And then another person that's set up, we don't have a date yet, is a person from the American Home Rental Council. Is there anything that anyone would like to add to the agenda today? All right, not hearing anything. I am going to turn it over to Rep. Lindsay for any comments that you'd like to start off with. Otherwise, we can also move into the presentations.
Thank you. And once again, I apologize for my air conditioner. It's hot as heck today. I have been catching up and listening to the meetings and presentations that I was not able to make. And there are a couple points that I wanted to hit that were brought up. So much of the discussion of, scope and definition. And I just wanted to give my 2 cents about kind of where this initial legislation came from. What Rep. Sharbini and I were looking to accomplish. And then after hearing some of the things that come up, just letting you know my thoughts on some of the things I think we should include and not include. And most of it is covered in the scope. I think that I just want to talk to you again about that. If I represent a community that is a lower income community. We have more renters than homeowners in this particular community. Obviously, not all legislation is going to be 100% tailored just to HD42, but I come into this thinking, and I think most of us agree, from a wealth perspective, a generational wealth perspective, that homeownership is an economic goal that many people aspire to. And so I am curious as to why sometimes that is not achievable for folks systemically. Obviously, there are things, the housing crisis it's a very complicated issue. Not one thing solves it. But I think that we have heard in the last several years a lot of talk on like a national level and from like politics and policy in that space of the impact of corporate ownership, of large corporate investors and their impact on the housing market. And so, like I said before, when Rep. Sharbini and I were looking at legislation to even begin to tackle that, we were having trouble with the data. Like, what is the data of how it impacts our state? And we've obviously continued to see some of those challenges from the data being different, data collection, all that kind of stuff. And so one of the questions of the task force was our intent with the task force was to figure out if this kind of mega investor situation, what it looked like on the ground here in our state. Obviously, I wouldn't expect it to be exactly the same across the state. And then what, if any, impacts that had on the housing market either making home ownership difficult for people to, get into that, or, impacting the cost of rentals. So I think that's kind of where this was born. We didn't know what we didn't know. And so after listening to the past discussions and presentations, it sounds like we are seeing that this mega investor is actually quite a small piece of the pie, which is interesting and helpful in itself of knowing that piece. I think even though like smaller investors or people that own 10 and under is a larger piece, the largest piece of the pie, I think that to me is also quite important in figuring out what can be accomplished on this front, because I'm very curious about impact. And so if it's not corporate ownership that's having this large impact on people's, home affordability, access to home ownership, rental pricing, I mean, I'm not only looking at that policy wise. Now, what this task force does or doesn't do, some of it may just be the work that kind of narrows out what we need to tackle on this end. And I think that would be beneficial in itself. But seeing that the data is showing that a larger number of single family rentals are owned by small mom and pop, I mean, that's just as interesting or concerning to me. I would like to figure out the impact of kind of any single family housing being owned by any kind of investor, whether that be small, people that even have 2, 3, I think that's not my focus is on that. But when people have several properties, 10 properties, that to me is still, that's still quite a high number that I'm interested in exploring. So, and I know there was talk about like fix and flip and like lease to own, those kinds of things. My ultimate goal is to help people who want to be able to afford to buy a home. So things that are doing that, businesses that are doing that, that's not necessarily my interest. I am interested in the impact of owning homes for investment purposes, whether mom and pop or otherwise, that take that home off the market for a person looking to own a home. So I'll end there. That's kind of generally just based on what I've heard from the other meetings, that just to give my own personal buy-in to this task force and what Rep Sharbini and I were looking to do. And obviously, as we've looked at it, even the definition of corporate, what that means or doesn't mean. I mean, I think we're starting to like narrow that in or understand at least the complications of what that having a definition means. And so I'm really excited about the work that's already been done. Sorry I couldn't be here for some of the meetings, but just wanted to bring that back in, is that I'm kind of recognizing we have answered some of our questions already, that actually the number of mega investors, it's not at this point. It's not as much as in other states like Arizona or Texas or Florida or something like that. And that's helpful information. And then so as we kind of tease out some of that data and learn more about what this looks like, I mean, for me as a policy maker, may steer my policy in a different direction or broaden it out. But the information that has already been collected has been very helpful in me understanding the situation. And so thank you for all you experts and all your great work, because I turn to you entirely to make sure I'm up to speed on this issue. So I will end there for now.
Super. Thank you so much, Rep. Lindsay. And I'm just going to make a quick comment. You'll see that there's a second Elizabeth that has joined the meeting. It is Senator Hinrichsen. Just so you guys know, oh, my face is me. Senator Hinrichsen's the other one. Any questions for Rep. Lindsay before we start with any of the presentations today? All right, super. And I want to thank you so much, Rep. Lindsay, for being here today and kind of reiterating your points and your thoughts. I think that's very helpful for the entire task force to hear and to understand. So with that, if there's no questions, I would like to first introduce, and I think he's still, can I still see him? Oh, there he is. Ari Rubin, and he is with a company called Flock Homes. It is, it's an interesting company. I had a great chance to chat with him a couple of days ago just to get a feel for what it is, but I think that this is an important lens to look at, especially when thoughts of trying to label different types of investor entities. So this is one of those. And so with that, I would like to have Ari take over, and I believe you can share your screen and you've got like a presentation to share with everyone.
Yeah.
And then we'll take questions. Ari, do you want to take questions during or after?
I'd be happy to take them during, after, before. Can you guys all hear me okay?
Yes.
Awesome. Well, first of all, I want to just start by saying thank you, Elizabeth, Rep. Lindsay, and to the entire task force for both your work on this issue, and also for inviting me to join today. Rep. Lindsay, I think you spoke, you made a number of really great points, and I appreciate your interest and what you're tackling here. I have a lot of thoughts, and I'm very passionate about a lot of the issues that you guys are trying to solve here. I'm going to try to narrow the focus of my presentation today on the business that I started and a little bit more about our specific focus in this ecosystem. But would be happy to answer any questions on any of the larger points, Rep. Lindsay, that you shared earlier, either during or after this as well, or even in a follow-up meeting or call. But today I'm really going to be focused on explaining to you the business that we're building. With that, I'll kick it off and just I'll say again, please feel free to interrupt with questions, comments. Happy to make this as collaborative and really as helpful as possible for you all. So with that, just a quick agenda that we'll run through. First, I'll give you a little bit of an introduction on myself and the business. I'll walk you through the problem that we're setting out to solve at Flock. I'll tell you more about how it works and who our clients are. And then I have two fairly specific asks that as I studied the very productive work that you guys have been doing as a task force, two asks that I have, and then open it up to questions. But again, please feel free to dive in with questions as well. Great. So a little bit about myself and the business. I launched the business in Denver with 4 homes about 3 years ago. Today, we own roughly 575 homes across the United States. We're headquartered in Denver. Colorado is still our largest market in terms of the dollar value of the homes that we own. We have 31 employees based in Denver, as well as in some of the markets that we operate, and as well as in New York and in San Francisco. And I've lived in Denver on and off since 2016. I currently live in California. So a little bit about the business. So at Flock, we're building the retirement solution for landlords. And we really have 2 types of clients that we typically work with. And Rep. Lindsay, as you pointed out, as you all know, the vast majority of single-family rentals are owned by individual mom and pops. I don't need to belabor all the statistics that you've seen. Roughly 80 to 85% of single-family rentals are owned by people who own 1 or 2 homes. 90% of single-family rentals are owned by people who own less than 10. And so our focus in our business is on what we call the accidental landlord. This is someone who typically owns 1, maybe 2 or 3 properties. I had breakfast with a man this morning. He is effectively the accidental landlord of a rental property that his 89-year-old mother, who is still alive, owns and lives off of that income in addition to Social Security. So we call these accidental landlords. They're folks who have inherited management of a property from a family member. A lot of people, they buy a house with a fixed rate mortgage on it. And then for whatever reason, they decide to not sell that property, to continue renting it out as they move to the next property. And now they're a landlord. Sometimes people retain property due to personal circumstances like marriage or divorce. So that's what we call the accidental landlord. The other persona, the other type of client that we work with, the other type of mom and pop landlord is the retiring landlord. And this is someone who oftentimes they worked in real estate, or they saw a nice opportunity to start a small business on their own. Yesterday, I was on the phone with a pilot who bought 5 rental properties over time. He didn't have a 401k, and he invested in local real estate as a way to build his nest egg and his retirement savings. So we call this persona the retiring landlord. And we're typically meeting this person later in life, right? They're in there as for the solution that I'll describe that we've built here. And I would say for all of these folks, regardless of where they are, the problem that we're solving for Flock, the core problem that we're setting out to solve is, I don't want to be a landlord anymore, but I don't want to sell. And the reason most of these folks don't want to be a landlord, and to anyone who's owned any rental property, any house, any owning, it's nice in some ways to own a house. It's also a lot of work. Being a landlord, being a good landlord takes a lot of work. You can hire a property manager, but you're still on the hook for a $10,000 repair, a $20,000 roof replacement. You're on the hook for liability. You're on the hook for all the repairs and maintenance that need to be done. You're obviously on the hook for the income stream, right? If you have a vacancy, that's on you. So to synthesize the problem that we're solving, and I'll tell you shortly about how we solve that, it's, I don't want to be a landlord, but I will not sell these things. I am not going to sell. And the reason people don't want to sell their rental properties is because the frictions, the taxes, and the costs are way too high. So at a certain point in every landlord's life, they get to the point where they're like, I don't want to deal with this anymore. But then after accounting for the cost to stage the home, to kick out the tenants. By the way, a lot of people don't like the idea of having to kick out the tenants, but if you want to list your property, typically most people prefer to do it vacant. So there's the staging costs, there's the downtime where homes are now sitting vacant. That's several months lost rental income. The big thing though is that, and then you pay, of course, brokers, you pay closing costs, you pay transaction fees. And then a big thing is you pay taxes, and you pay something called depreciation recapture, which is a part of the tax, which makes owning real estate so beneficial. But when you sell it, ultimately, it's a huge tax burden. And then, of course, capital gains tax. And for many of these folks, especially retirees, they don't have a lot of income, but the act of selling is going to push them into higher tax brackets. And so it's very punitive. And I have a slide later here in the appendix to illustrate, but the vast majority of these folks, they will never sell. Their plan is to pass them on to their heirs, who will receive what's called a step up in basis, and go from there. So just to synthesize.
I'm sorry. All right.
Yeah,
I know this. It's Teo. I know that you're sounds like you're going to cover this in the appendix, but can you, Representative Lindsay did bring up an excellent point about building wealth and building generational wealth. Can you clarify what you mean about the taxes that I would pay if I sold versus if my heirs inherited this property?
Yeah, absolutely. So typically, I'll just the summary of it. There's 2 types of taxes, and it all depends on how long you've owned for. But the 2 types of taxes is, one, it's called depreciation recapture. So depreciation is something that is very beneficial as you own real estate. It's a way to take paper losses to offset. It's not a way, you have to actually do. By the way, regardless of if you take depreciation, the IRS says when you sell, you have to pay the recapture tax. And so that is roughly 25% of the depreciation you've taken. And then you pay capital gains on the gains from when you purchased the home to what the current sale price is. So depending on your tax bracket, that's anywhere between 15 upwards to 40%. And certain states have net in NIIT taxes. And the fact that you're hitting it all in one calendar year is also a big tax burden that people hit. So on average, and you'll see this in a later slide in the appendix, if you've owned real estate in the state of Colorado for 20 plus years, rental properties, there's certain tax incentives for owner occupiers. But if you're a landlord or an owner of any type of asset, stocks, anything, when you sell, you pay capital gains taxes. And that would be on average in the state of Colorado, you could be facing up to a 30% loss of your equity to sell. And just to conclude that, Teo, what a lot of people end up doing is they pass on these assets to their heirs. When the heirs, this has been part of the tax code since the 1920s, people who inherit this receive what's called a step up in basis. So the heirs would be able to sell these things that would receive the current value as their tax basis and then sell with very, very little tax consequences.
Thank you.
Yep. The reason I think this is a big problem is we deal a lot with mom and pop landlords, and there are millions of homes in this country that sit neglected, underutilized, and underinvested in. And it's because it takes a lot of work to be a good landlord. And a lot of these mom and pop, there are certainly bad landlords out there. There's bad people out there, but it takes a lot of work. And most people who are at this stage of their life are not interested in having the level of hands-on involvement that it takes to bring a home to its highest and best use. And we know this very, very intimately. We've dealt with thousands of retiring landlords and accidental landlords. And I'll share some of the stats with you guys later of what we find. But we have many homes that were sitting vacant before they come into Flock. They had $50,000 or $100,000 in capital improvements. They had 2 unlicensed rooms in the basement that could potentially be bedrooms if you wanted to bring them up to code and install egresses in there, but who has the money and the cash and liquidity and the wherewithal to do that? And so I'm very passionate about this problem because I think not only as you guys study this, you will see more of the numbers. We're short millions and millions of homes in this country as a result of being underbuilt for many, many decades for many, many reasons. But additionally, there's many homes out there that are just simply underutilized. They're sitting vacant because they're a tax liability, because the owner doesn't have the wherewithal to do something about it. And that's the problem that we're trying to solve with Flock. So at Flock, what our business is, we've created an investment partnership that is owned by mom and pop landlords. So the way our business model works is we've created an investment fund. You may deem this as a corporate owner. And one of my goals in this discussion today is show how there's a lot of nuances in who are the beneficial owners of these structures. What an accidental or retiring landlord will exchange their rental property into our partnership using something called a 721 exchange. And what that means is it's a tax deferred way for them to exchange their properties for shares in our larger partnership. So just for really simple numbers here, let's say a mom and pop landlord owns a $400,000 rental property. They would sell that property, they would exchange it for shares, for units in our partnership that we've created. They now get back that equivalent value. They no longer own that home anymore. They don't manage it anymore. We take over all the management and the responsibilities of that. And they are now, but they don't trigger any taxes in doing it. And they're now able to continue receiving all the benefits of their ownership, the tax benefits, the cash flow that many of these people live off of, in addition, of course, to Social Security, as well as the continued appreciation from the housing market. But instead of them being an individual landlord, they are now a passive shareholder in this fund. And of course, our company now takes over all the responsibility of management. We acquire the rental property. If there's a resident in place, we hope that there is, and we hope they stay. When residents move, we always address, and we'll talk more about our process. We put in on average about $45,000 of capital improvements to all the homes. Most of that is for immediate health and safety needs that need to be done to the home. Yeah, we now take on management. And I'm just now I'm looking at a question here. I'll just open up to some of the question. I just received a question, which is there's a question which is how we think the investments and changes that we make to a home, to a for sale home like the one that was pictured, impacts property taxes and the homes around it, and the ability of low to moderate income people seeking home ownership to purchase that home. So I want to be just clear about two things. One, that the vast majority, just to be very clear, the vast majority of rentals that we work with in Flock were never listed for sale. And they will never be listed for sale in the foreseeable future because these mom and pop landlords want to continue owning them, right? They find us, they will not sell because of all the reasons I laid out. And so I just want to really make that clear at the beginning. We do a lot of value add improvements. I think there's, on the one hand, value add improvements. They certainly do. In some cases, value add improvements have the potential to increase property taxes on neighboring comparable homes. As we'll walk more into, they also provide more housing. They provide more rooms for residents to live in. And most importantly, half of the value add improvements that we do is immediate health and safety concerns. And so addressing electrical panel repairs, of course, if we upgrade the kitchen appliances, that impacts the value of the home, but also just immediate health and safety concerns, which I'm not an expert on property taxes, but a lot of that value add, I don't believe, I think it's just necessary that any responsible landlord should be doing. I see another question from Kinsey.
Yeah, hi, Ari. Thank you. I'm the one who asked the question in the chat. I just didn't know at what point you would want questions. So following up on what you just offered, thank you for the answer. I think another question I have, hearing from Representative Lindsay earlier today, she reminded me that some of her focus and intent was also trying to understand the impact of homeownership by corporate or even smaller entities, the impact on rents, and I think just basically people's ability to live in communities. So I'm also curious whether now or at some point later in the presentation, if you would be willing to speak to how the rents, understanding that none of the properties you're acquiring were planning to be on the market and you won't put them on the market. So how do the rents differ, I suppose, from when you acquire those properties from mom and pop landlords when Flock is managing them? Thanks.
Yeah, I'll quickly touch on this, but maybe we'll return to it later. First of all, we honor, of course, all existing leases in place, and we keep rents at what we deem to be fair market value. I think if you're doing a renovation to a property like you saw on Cueva Street, where you're putting $100,000 of renovations into that home, that warrants a higher rent for when we list it. And I think, yeah, I think our goal is to provide folks with reliable and safe housing. We have a fiduciary to our clients, to these landlords who are counting on, and I want to speak a little bit more about them because I think that's the main focus of my presentation today, but would be happy to talk more also about actual rents. We're a pretty small player here. We own less than 100 homes in Colorado, but we'll speak to that a little bit more. Again, just the main point that I want to hit here, the vast majority of our clients and the thousands of others that have reached out to us and inquired about Flock in the past, they're not selling their real estates because of all the reasons we laid out. They're continuing to leave them as is, with every year more deferred maintenance, every year more problems, and which ultimately falls on the community and the residents who are living there. And we have a lot of case studies, but I'm going to talk about a couple here. So there's been a couple names as far as, and I'm sure in part of your process, we've seen a lot of names as far as corporate ownership of housing. And I want to stress here that we're a different kind of investment partnership. So you guys, I think, are familiar with companies like Invitation Homes, Progress Residential, American Homes for Rent. I think they're the 3 largest in the country. They are structured as real estate investment trust. They're structured as investment partnerships. We are also an investment partnership. In some ways we're similar, in some ways we're very, very different. And one of my goals is to explain the distinction. And I think there's a very, very important distinction that needs to be made. But also, and so just quickly on that, the way much of these investment partnerships or real estate investment trusts work, they have investors. Those investors are cash investors. They are investing money with the goal of generating returns. They go out and buy a bunch of homes, and then they rent them out, and they generate rental income. They renovate, they manage them, and that is their model. And sometimes, again, there are different. They're structured as a corporation. Sometimes they're structured as LLCs, as investment partnerships. To be clear, Flock is also an investment partnership. We are a pooled investment vehicle that owns rental properties. The difference, though, is our capital base, right? Our investors are these mom and pop landlords who you're going to hear a little bit more about today. And rather than them investing cash, right? They're not investing $20 million of cash to go buy homes. They are rolling their investment properties that they already owned, that were already rental properties, into this partnership and getting back shares. Of course, their goal is like any other investor. It's like what their goal was prior, which is to generate cash flow, appreciation, the tax benefits of owning, or the tax treatment of owning real estate. But of course, the difference is that we own these homes in our pooled investment vehicle. So I'm laying this out here to sort of just start by saying, like, depending, and as part of one of my asks in a little bit is going to be to look at these investment partnerships and the incentives of these vehicles and who the capital sources are. But in some ways, you can look at our vehicle and you can say, oh, you're a large corporate landlord. I would strongly urge, and I think everyone here on this call would agree, that the clients that we have, and we're going to talk about them shortly, are very different than a large, distant cash investor that's investing billions of dollars to buy up all these homes. I have another question here, just quickly. What guardrails on homes will we consider? Minimum, maximum value, location? It's a great question. Typically, in our current in Flock Homes today, we take 1 to 4 unit single family rentals, duplexes, triplexes, and fourplexes. We are in minimum, maximum value. It's typical across the country. It depends on the market, but typically in Colorado, the lowest purchase price is around $350,000, $300,000, with the maximum being up to $1.5 million. In location, we want to be in markets. We're in Boulder County, we're in Denver County, Arapahoe County, really just large. We're in Colorado Springs, large MSAs where we feel we have the ability to manage these homes and price them equitably. And there's another question: can renters have the option to purchase the home they're renting at any point? How is the purchase price of the homes you acquire determined? And do the sellers that, I wonder if there's people who are actually interested in our business because they own rentals here. There's some good questions. We have plans in the future to roll out sort of more of co-ownership models with residents. That's something that we're actively exploring now. We don't currently have any rent-to-own options. There's a lot of companies out there that offer that. Not that many have been that successful at it, but we're working actively on figuring out a co-ownership model to allow residents to get upside and equity in their homes. We're not there yet. There's a lot of, I'd love for your help in lobbying against some of the larger sort of national regulators to help us see that into fruition. We value the homes on a quarterly basis, so we use appraisals and third-party valuation models similar to CoreLogic, which I know is a company that's coming to present to you guys. So we value the homes quarterly based on appraisals and what's called AVMs from companies like CoreLogic. Great. I want to tell you 3 stories of clients, and we have hundreds of these stories, and you will be able to access these, but I want to tell you to really make clear the distinction here. So this was one of our first clients, Shirley. Shirley is a single mom. She's an MD. She ran a hospice. She recently retired. Her rental property was her former primary residence that she lived in for 15 years. She raised her son with special needs in that home. She had a goal that her son would one day move back into this home and live there on his own. That's why she kept it. That was not able to be played out. And she had a very strong emotional attachment to this home, as well as a financial attachment. She had a lot of equity built up in this home. She's thinking about her son's financial future, and she saw this as a cash flow to support her son when one day, hopefully in many years, but when one day she's no longer around. A little bit about the house. The house was sitting vacant for 6 months when she first heard about Flock. A beautiful house on South Dallas Court in Denver, sitting absolutely vacant. And she had offers every day from flippers and home buyers, and she was not selling this home because her mom was a real estate investor and impressed on her the ability to build wealth in real estate. She did not want to sell this home. She also needed $70,000 of work into the home. Most of that was health and safety. If you drive by that home today, it looks very similar. She had tons of deferred maintenance in there because it had been, she had put very little work and money into the house over the years. And it was largely health and safety issues. And when she put her house in Flock, we installed new egress windows. We added 2 additional bedrooms, all of the health and safety issues, and the list goes on. It's electrical, it's trip, it's water damage over the years, it's the sewer line, it's a lot of damage. And if you ask the neighbors also on this, like this was the ugliest house on the street with a lot of damage that was actually damaging other homes because of some of the backups and the flooding that had occurred. And Shirley is one of our first clients. She exchanged her rental into Flock and received back shares in our partnership. Great. I want to be mindful of time, so I'm going to keep going here. I just got a little time check. Another story, Rick. Rick tears at my heartstrings every single time I talk to Rick monthly. Rick lived in Virginia Village. This was his primary residence. He lived in Denver for 50 years. This was his primary residence. He got married. He moved to North Carolina later in life, which we're very happy for him for. He turned this into a rental property. This was all of his net worth. He relied on this cash flow. His wife had a stroke, and he needed a little bit of liquidity. And he can't borrow. I mean, what do you do when you're in your 60s and you need a little bit of liquidity? He can't borrow against this. He needed to pay for his wife's medical bills and still continue to. He was able to take a little bit of liquidity out from Flock, but not lose his whole nest egg, his whole investment. Rick truly lives on his Flock cash flow plus his Social Security. And he couldn't, when you speak to Rick about this idea of him being a corporate landlord, maybe you'll have him on one of these panel sessions or speak with him and hear his story. I think, it's quite shocking to him. His house was falling into disrepair. The residents, no one was ever happy in this home. And there's mostly owner occupiers in this community where he lives, but also it's a nice opportunity to have people who would not otherwise be able to buy a home, live in this home in a good school district. And Flock did a lot of improvements to this home. Lastly, John, I'll go quickly through this. This was a 4-plex down in Colorado Springs, started real estate investing. He moved away. He didn't want to deal with it anymore. There was almost $100,000 of improvements. There were squatters in the house. He just didn't want to deal with this. He was sitting on a tax issue. He didn't want to tend to this. And we've now made this, we put in laundry facilities into the 4-plex. We've upgraded the exterior to the house. Great. We have many of these stories. Bob is one of our clients. He's a reverend. He lives in Northern Colorado. He's in his late 80s. He put 2 rental properties into Flock. He's building his nest egg for his family. Many of these stories, and would be thrilled to share more of these with you guys. And one of my asks, but I really believe this, these folks deserve a seat at the table. They are the largest owner in this cohort and of landlords. And I have 2 asks of this task force just to wrap it. I'm trying to be mindful of time. I know I'm rushing a little bit here, but we got sidetracked with some questions earlier, which is great. But the first thing is, if you end up in the task force proposing legislation limiting ownership, I would really ask and urge you to consider who the actual beneficial owners are. So in my mind, and I think everyone here would agree, that Rick and Shirley and John and all these folks are very different than a large institutional investor that is pouring billions of dollars from halfway around the world. There's a big difference between our client base. And in fact, when you unpack what these corporates, and I put that in quote, there's a lot of nuance here. There are many ways to distinguish between moms and pops and large institutions. I have some ideas on that. There's been a lot of advances in terms of the Corporate Transparency Act, which was passed earlier this year. The structure and the mechanism by which beneficial ownership is recorded. And so I would really urge you to dive into who these actual entities are. Again, there's REITs, real estate investment trusts, that are owned by retail investors. There are investment partnerships that are owned by one entity. There are investment partnerships like Flock that are owned by many of your constituents and many just local moms and pops. The second ask that yeah, Elizabeth?
Oh, I thought you were done. So I was going to ask the task force for questions. So if you could just wrap it up in about 30 seconds.
Yeah, just the last ask, and I'm sure you guys have heard this, is please consider the benefits that that well-capitalized active owners bring, not only to other owners in the area, but also to residents and to communities. There is nothing worse and sadder. We've walked this, and we can share more. Thousands of homes owned by retiring accidental mom and pop landlords, where the residents are living in terrible conditions, in totally unsafe and unhealthy conditions, because not to the fault of those moms and pops, but they don't want to put in they don't have the ability to put in the upgrades. We on average spend $50,000 improvements per property, 50% of them going to immediate health and safety issues. So that's a wrap.
Super.
Thank you.
Yeah, no, thank you very much. I'm going to first just make one bigger comment. I've been able to look at a couple of the chats and questions that have come in, maybe more privately than on the public side. And this information that you've shared in a way contrasts with what maybe Rep. Lindsay brought up at the very beginning of the discussion today, is really looking at the negative impacts of corporate ownership and investors. And so there has been concern on, so why are we having somebody come in and talk about what are potentially the benefits? And I guess I want to reiterate to both the task force as well as the other listeners, and maybe more the other listeners online, that in this analysis, it's important to look at both what are the benefits and drawbacks in it. And initially, at the very beginning of the task force, the idea is kind of behind a lot of things is to minimize the negatives and leverage the positives. So that's why we've had a different type of firm present information about their model. So I wanted to clarify that, because there's definitely been some concern of why we're even having you be part of it today. So I wanted to try and clarify that. Does anybody, we've got about just a couple of minutes to ask Ari some questions about the impact or about his company. And I think Heidi has one, I know, in the chat, and then we can see if there's anybody else. So Heidi?
Sure. Yeah, thank you for the opportunity. I can't see the Flock person, so I'm sorry. I feel like I'm speaking to a bunch. Oh, there you are.
I'm here.
I was like, I'm trying to make eye contact with you. So I have a couple questions, and I think these are pretty fast. How you find buyers, or how buyers find you? So like, what's your model to market to them? And then sort of associated with that is, are you focusing like on certain neighborhoods where you think like, obviously you're a business person, right? So you're looking at where could get value from this transaction. I'll start with that, and then I have one sort of tax question too.
Yeah, great question. So to be clear, Heidi, that's a great question. We are not trying, like our business model, we are not trying to buy these things low and sell them for high. we just to be very clear, and I want to just speak to Kinsey, you had a question too, is Flock the ultimate owner? Flock is the managing member. Flock is the general partner of this investment partnership that we created. So what our goal is to provide these clients who are rolling their properties in with diversification, with tax savings, right? And so so we are the managing member, but they remain the shareholders of the fund. And that's what, again, just one of my really, just to be very explicit about this, ask the shareholders, the actual owners of the partnership that owns all the homes. It's the retiring, it's the mom and pops, right? They retain their equity, but instead of it being in this individual house, it's in this larger investment partnership. And so one of the asks here is to, when you look at investment partnership, is it one investor who put $1 billion in from, halfway around the world, or is it moms and pops in the community, so on and so forth? Heidi, how do we market? A lot of it is words of mouth. We also send out direct mailers. And the way we're targeting accidental retiring landlords. And so you can, it's basically folks who own rental properties, who have owned for a long time, and a lot more there. But again, our goal is that we're not trying to buy these things low and sell them high. We're trying to create a diversified investment vehicle for all the clients in the partnership.
And I have one other question, which is, so if we're thinking about sort of your business aside, like big picture, there are units that are sitting vacant that could be put to more productive use, right? Either in sort of reasonably priced rentals or starter homes for folks. Isn't the problem really the taxation, not necessarily? You seem to me, and that's kind of how you started this. It's like, I'm solving for this tax situation that these people are in, right? So if I were to wave a magic wand and solve that, then wouldn't it be sort of your business side? The win-win would be, I'm returning a unit to the market. I'm allowing that accidental landlord to sell and returning a potential starter home to the market that's been sitting vacant. Like, isn't that a preferred solution?
It's a great idea, and people have talked about this in the past. It's to be at a federal level, providing tax incentives. I don't think that still solves the larger problem, which, depending on your estimates, we're still short millions of homes and units in this country as a result of decades of of being underbuilt. I think a larger, just like talking about underutilization, like where we are in Denver, it would be a lot easier if in areas like in Park Hill, if people could build ADUs, or you could turn single family homes into duplexes, which would allow people to get more affordable entry-level housings. And so I think tax is part of it. But I don't think it's the be all. Even if there's a massive federal overhaul of the tax code, it's still not going to bring 4 million homes that we're still short in this country online in the coming years.
Thank you. That's all I've got right now. Thanks.
All right, and I really do need to move on to the next speaker. I know, Teo, you've got your hands up, and I think I've been looking at the chat. I think Kinsey's been asking questions as well. Kinsey, do you have any other question, or do you feel like you got it answered?
I got it answered. Thank you.
And Teo, giving you a 30-second.
Okay, I'll keep it real short. So first of all, Ari, thank you for taking your time to be here to present. My question, and it piggybacks off of Heidi's, which is this idea that you've shared about that you've done things like added bedrooms, you've taken previously vacant units and put those into the marketplace, and then obviously done capital improvements. And my question is, what is your sense in terms of the impact on the quantity and the quality of rental housing and the access that those rental houses provide for families who aren't in a place to purchase right now, but might want to access quality neighborhoods and quality houses? What have you seen being kind of immersed in this business?
Yeah, I mean, that's the biggest part. I didn't even touch on this part of the story, but we're neglecting a massive swath of the population, which is people who don't have the money for a down payment. They don't have the ability, and that's not going to change with, that has to do with, how much it costs to buy a home and what interest rates are today, right? And all the other structural issues here. And I think something that we find really rewarding is like that Virginia Village house, bringing a quality rental home in that community. And if you drive around the certain areas in Denver, right, where they're predominantly owned by owner occupiers, you can easily tell what the rental properties are, because typically they're owned by a landlord who doesn't want to put in the money or the resources to bring them up to the standards of the other homes. And that's not fair to the residents who want to live there, who don't have the ability to buy a home. So I feel very passionate about this. We're discriminating against a massive percentage of the population who don't have the ability to buy a home. But if they want to live in a certain neighborhood, they're going to be suffering and living under these conditions. And I'd love to do more. I wish, we could add more units, we could add more ADUs, we could add more livable space. But Elizabeth, I'll stop there.
Super. I appreciate it. Thanks, Ari, for your information. I think behind this is that, again, when we're doing these kind of filtering by types of entities, that it's important to understand that there are these different types of entities to look at in the analysis and understanding a little bit more about them. So we'll make sure that the task force and others have Ari's contact information if there's interest in reaching out to him with other questions. With that, a lot of information was brought up about what is the current housing market. And so we are fortunate to have with us today, Cooper Thayer, and he was introduced to us from the Colorado Association of Realtors. And he's going to give us a little bit of information about where are we in terms of the housing market. Thank you, Cooper, for being with us today.
Yeah, thank you, Elizabeth. I appreciate you having me on here, and thank you to everybody else for having me today. My name is Cooper Thayer, and my expertise is in residential real estate sales. I am a realtor with the Thayer Group out of Keller Williams Action Realty in Castle Rock. And my goal today is to provide you with information about the sales market, right? So what does the residential real estate market look like statewide in terms of sales? And hopefully the task force can use some of this data and insights to determine what impacts have corporate ownership had on these facts and figures that I'm going to give you today. So I'll give you a super quick background on me. Born and raised in Colorado, grew up in Castle Rock, attended CU Boulder, studied finance, real estate, and economics. And now I have the pleasure of serving clients throughout the Front Range, pretty much everywhere from Colorado Springs to Longmont, and buying and selling homes, everything from first-time home buyers buying $200,000 condos up to luxury buyers in the $2 to $3 million range. And I also have the pleasure of working, when I'm not working with clients, with the Colorado Association of Realtors on our legislative policy committee, as well as a market spokesperson for Denver County and Douglas County. So I get to disseminate information to the community and to the general public about the housing market. And that allows me to do presentations like this, where I get to absolutely nerd out on real estate and share interesting facts. So I want to jump in and start with a little bit of history, just so we can take a look back at what's happened in the housing market in the past couple decades. So this here is a chart of the All Transactions Housing Price Index for Colorado and the United States. Quick caveat: this is the FHFA index, so not exact prices, but this is representative of what has happened in the market. And you can see since 2000, in the past 24 years or so, Colorado's transaction prices have increased at a much faster pace than the rest of the United States. So on average, we're about 5.1% annual appreciation over the last 24 years, about 0.5% higher than the US average. And you'll notice around 2012, 2013, these lines started to diverge as the pace actually picked up even more in Colorado. So let's take a quick zoom in. So this is that same chart, just zoomed into the previous 10 years, where we saw actually an even more extreme difference in the pace of appreciation in Colorado. So we're looking at about 8.6% average annual appreciation in Colorado, which is more than double, more than doubling in home values to about 2.3 times, compared to just under double for the U.S. average at about 7%. So, Colorado has seen this rapid appreciation over the past 2.5 decades, even longer. And it's really even been exaggerated even more in the past 10 years as the real estate market really heated up to one of the top markets in the nation. So this is a little bit of a dense graph, but I don't know if anyone remembers 4 years ago, things changed a little bit in our lives. And we saw significant changes in the real estate market from COVID that are really still wearing off. And what happened was, basic economics, supply and demand. We had both a supply side shock and a demand side shock nearly simultaneously at the beginning of the pandemic, right? Supply decreased very quickly. People decided they did not want to move. There was economic uncertainty, so less and less homes hit the market until we actually, in around 2021, 2022, reached an all-time low inventory. That's that red line there is month supply of inventory, which is representative of kind of the velocity of the market, how long it would take to clear out all the listings on the market at the current sales pace. And over the what we'd consider normal here, and we'll dive into this a little bit more, this 2015 to 2019-ish range, about 2 to 3 months of inventory, is what we'd consider fairly normal for a highly desirable, high cost of living market like most of Colorado and our metro areas. The blue line here is actually the monthly median close price here in the RE Colorado MLS, which is the largest MLS for the Denver metro area. You can see here that starting right at the beginning of the pandemic, that rate of appreciation increased a little bit more rapidly. As less homes were taken off the market, that decreased supply. And as more cash was injected into the economy through stimulus checks and the reduction of interest rates, mortgage rates hit an all-time low of about 2% on average for 30-year mortgage rates. Buyers had more cash. There were less homes on the market, so demand decreases, or demand increases, supply decreases. That's a double whammy. We get increases in price. And we actually hit an all-time record in the spring of 2022 in Colorado with about $600,000 median close price. And that's the RE Colorado MLS, but the entire statewide figure is very similar to that. So simultaneously, we've got no inventory, we've got ultra high prices, and it created a very highly competitive environment in the market. So let's kind of zoom in a little bit more and take a look at where we're at today. Apples to oranges is a little bit of a tough comparison in real estate, so we like to piecemeal things out a little bit. So we're gonna start with single family detached home. So this is your typical home, 1 unit, 1 building, 1 house. And as of May, some of these figures will probably not be too insightful in abstract without context, but I want you to pay attention to the year-over-year changes, and I'll dive into these a little bit more as well. So right off the bat, we see that median close prices are up about 4% last month compared to last year, and they're actually very, very close to that all-time high I mentioned of 600,000 in the spring of 2022. So interest rates have tripled, quadrupled in some cases since then, but we're still seeing all-time high pricing. We're probably not going to touch it this year, but we are just below all-time highs in pricing. Inventory has increased dramatically in the past year. We've seen a lot more homes come onto market. In fact, we're about 25% higher inventory just in the single family market, and this is even more extreme in multifamily, which we'll touch on in a minute. But that represents about 3.1 months of inventory, which is quite high for a highly desirable, high cost of living market like we're in here. In fact, it's a 40% increase, very dramatic year over year. And with that inventory, things slow down, buyers have more options, and homes spend a little bit more time on the market. We're up about 7.5% to 43 days average days on market this year. One last figure I'll point out, this is actually one of my favorite market statistics figures, is the average percent of list price received. So this is the ratio of the list price to the closed price that is reported at the end of a transaction. So we reached all-time highs in 2022, where we were actually seeing average close price at about 105, 106%, which means homes on average were going for 5 to 6% above asking price. And this was a result of crazy bidding wars and just that excess demand and super low supply. Today, things have balanced out a lot more. 99.5 to 100 is about the typical range that we see. So we're at about a normal range here in the single family market. But definitely that seller edge, that seller advantage has been taken away as more inventory has flooded the market and buyers have become more accustomed to increased interest rates. So on the other end of the spectrum, let's look at multifamily, where the story is actually quite different. And a lot of the entry-level housing stock is going to fall into this category, these condos, townhomes. This represents everything from 1 to 4 units of multifamily. So anything that's attached to another unit, we consider multifamily. So a lot less listings. You'll see that new listings on the market, 3,000. So multifamily accounts for about 20 to 30% on any given day of new listings or closed listings. Median close prices actually have decreased in the multifamily segment, and they've stabilized a little bit more, especially in the past couple of years, and we'll dive into why in a moment. But similar time on market, although a pretty significant jump year over year, up 30%, and supply has just skyrocketed over the past year in the multifamily. We're up to 3.3 months of inventory, almost 60% higher than this time last year. 40% more homes on the market, and it looks like somewhat of a buyer's market actually in the multifamily segment, as the percent of list price received has decreased down to 98.9, which is a little bit on the low end of the normal range. So supply, I've touched on supply quite a bit. I want to dive into that a little bit more. So we're at 3.1 in the single family market. We're at 3.3, so we're about 3.2 months of inventory statewide on the market. And the last time we saw that level of inventory, we've touched it maybe a couple times, but the last time we were consistently above that level of inventory was in October 2015 and prior. So you can see I created a little kind of a heat map on the bottom there that indicates who takes advantage of these market conditions. When there's more homes for sale than there is buyers, that's a buyer's market. Sellers need to sell. They don't have enough consumers to purchase their product. And the buyers have the advantage in those transactions, which we saw, coming out of the global financial crisis. There was tons of homes on the market, foreclosures, things were cheap, interest rates were decreasing. So there was a lot of advantages for buyers. And we kind of entered, again, this normal period. What I'd consider the normal period for Colorado is this 2014 to 2019 range here, where it's a moderate seller's market. And that's what we could expect from a market where we have such a high quality of life, such a desirable place to live, and not a lot of homes for people to purchase. Obviously, when we dip down and touch that 2 weeks of inventory in 2022, it was an extreme seller's market. Again, bidding wars, homes on average going for 5 to 6% above asking price. And now that we're climbing back up, and it's I say may have stabilized to balance levels here, and that's very intentional, is because everything's cyclical. We're approaching the top of our annual cycle here in terms of inventory. So it's to be determined whether inventory will continue to rise above that 3-month mark on a consistent basis, or if we'll see more fluctuations and inventory will decrease once again. Also diving into price here. So like I mentioned, we're near all-time high prices, just about $2,000 off of the April 2022 all-time record in the single family market. However, you can notice there's actually a significant difference in the price trends for single family versus multifamily housing. And in the past 2 years, especially, we've really seen that median home price level out in the condo and townhouse market. They reached $435 in the May of 2022, or in the spring of 2022, and we're about $415 now. So a little bit lower relative to what's happening in the single family market. So let's touch on that a little bit more. I know entry-level housing is a big concern of the legislature. It's a huge concern of the residents of Colorado, and the multifamily market is definitely a challenging environment to be in for a number of factors. And corporate ownership may be one of those, but I want to touch on a couple of what I consider the primary factors that we're looking at. So number one in the multifamily market is HOA dues. It's cost, it's insurance and HOA dues, I think, are the primary drivers of why we've seen some challenges, especially in that entry-level market. So I pulled some data here. This is a sample of closed listings from the RE Colorado MLS, both from May 2019 and May of this year, just last month. These are annualized, so keep in mind these are not monthly, these are annual HOA dues. We've seen about a 27% increase in single family and a over 31% increase in condominiums. So, you know, you'll notice there's nominally we're nearly 10 times as high on HOA dues on the average condominium in an HOA versus the average single family home in an HOA. And it's a widespread issue, as Colorado is actually probably the second most, we have the second most percentage of residents in the country living in an HOA. Over 40% of Coloradans live in an HOA. So this is a widespread, broad challenge that's affecting tons of Coloradans. In fact, probably near half of Coloradans have been directly affected by the increasing trend in costs of HOA dues. And one of the drivers behind that is obviously inflation. We've seen maintenance costs increase. We've seen just the cost of operating a condominium building increase. And one that you've probably heard in the legislature recently is insurance costs. Home insurance costs have absolutely skyrocketed. And in fact, over the past couple of years, we've seen over a 50% increase in average monthly premiums for home insurance. So when you're looking at entry-level housing, you know, it's a little different from a buyer perspective on what is important to them. So a buyer of $1 million house, they're probably not too concerned with minute details in their monthly payments, right? Whether they're paying $5,000 or $6,000 a month in a mortgage, sure, it has an effect, but it's not a necessity. It's not, it turns into more wants versus needs. Whereas in the entry-level segment, we're looking at people who need to be in a home, and those monthly budgets are incredibly tight when you're talking about 5, 6, 7% mortgage rates and insurance premiums 50% up, and increases in property tax assessments, and increases in HOA dues. So my opinion is that, you know, these monthly costs, these variable costs, or not variable, but these fixed costs of owning real estate has significantly challenged the entry-level market. And I think we see that reflected in the data of multifamily, the performance of the multifamily segment versus the performance of the single family segment. Underlying problem and Ari touched on this a little bit, is that we have a huge shortage. There's just an underlying shortage of housing in the country, and more specifically in Colorado. And this is a great report from an organization called Up for Growth that is, I highly encourage everybody to look up and read. They put out this annual report on housing underproduction, so the lack of construction. And it looks like, you know, as of a couple of years ago, we're about 100,000 units short on the construction side per year in Colorado statewide. And, you know, we can dive into some of the more specific metro areas. About half of that is in the Denver metro area. But, you know, as a share of total housing stock, you know, over 4%, over 6% in Greeley. These are just significant shortages in housing, in the production of housing, in the availability of housing. And the effect that has is kind of twofold. One is in a good economy, in a confident economy, that's going to increase prices more. And the reason is, of course, we have a limited supply. More buyers and less sellers means higher prices. But in a bad economy, what that does is it actually probably softens price depreciation and softens some of the challenges that the housing market may face if the economy were to turn down. And the reason is we have this underlying shortage of houses that will keep prices, keep elevated pressure on prices, and could probably prevent a significant or a quick tanking in home prices in the market. I know we've touched on this a little bit, but I had to say my piece here. This is obviously my personal perspective as a constituent, and my firsthand experience working with small investors. But the important thing for the task force that I believe to consider is again, who is the beneficial owner of these properties. We work with a lot of small-time investors, people who own just a few units. And I know you may not have seen this yet. This is actually a time series graph of what it looks like, what has happened recently with investor home purchases. So on the left from Burns Real Estate Consulting, you can see the nominal number of investor home purchases has increased in the past couple of years. But on the right from Freddie Mac, we can see that the actual overall share, proportional to the number of homes being bought and sold by owner occupants or non-investors, has actually remained fairly stable. So, obviously, I'm not intending to minimize the potential impacts of corporate ownership whatsoever, but rather, provide an important perspective on the scale and the scope of these activities, and prevent there's a big risk of overreach potentially with legislation. So I just encourage the task force to take a very cautious approach in recommending action to the legislature, and be cognizant of the potential broad-reaching effects that can impact everyone in Colorado. So I know I zoomed through that super quick. I know we're short on time, but thank you all so much for your commitment to the task force, your service to the people of our great state. And I would love to open it back up for questions. I did not look at the chat. I don't know if we have questions here, but I would love to answer any questions, go into more depth on any of the figures that I presented.
So Cooper, I want to thank you so much for your presentation. I think it was great information, and to see where we are currently, and to understand especially the single family, I guess the owner occupied housing market, and how that's been changing over time. Does anybody have any questions for Cooper regarding kind of the housing market, what he's seeing in terms of this kind of single family market? Teo?
Cooper, again, thank you for taking the time to be here and for doing the in-depth data analysis. So we appreciate you. My question to you is, and again, knowing and hearing the task force is very interested in kind of entry-level homes. My question to you is what do you think is the primary driver of the of the increase in prices we've seen? It sounds like you were saying lack of supply, but I want to make sure I understood you correctly.
Yeah.
And I should say production, right?
Yeah, production, lack of supply. And again, these are all hot issues in the legislature. Condominium development, we had a boom in condo development in the Denver metro area, specifically in the 80s and 90s. And then the construction defect litigation issues came up, and in the 2000s, I don't remember the exact figure, but I believe in the past 10 years, it's something like less than 5% of new housing starts in Colorado have been condominiums. So we have, a multi-factor issue here with condominium affordability, especially as we have a lack of supply to begin with. We have a lack of construction, and in a lot of the new construction that you see, we have a lot of cranes going up. Those are either apartments or high-end luxury condos. And then we have just the ongoing carrying costs from both the HOA, the association perspective, and the individual homeowners. The associations themselves have incredibly high insurance burdens. They have high maintenance and upkeep costs. And then the homeowners have insurance to worry about, taxes to worry about, interest rates to worry about. And in a market where condo prices have started to level off, now we can't quite use appreciation as a return on investment anymore for condos, broadly. So it's hard to rationalize spending so much money per month on a home that you're not quite sure is in 5 years going to be worth more. So kind of a lot of factors at play, but yes, I think underproduction and the lack of supply is a major one, and possibly the primary factor that's prohibiting affordability in the entry-level segment.
Super. Thank you, Cooper. So any other questions for Cooper? Otherwise, we've got a lot of content to try and cover in the next 10 minutes. I want to thank you, Cooper, so much for your presentation. And if you'll make sure that I don't know if you shot it to Adam ahead of time, but if you wouldn't mind maybe shooting us a PDF, because we would like to be able to post that
Absolutely
with the rest of our public material.
You got it. Well, thank you guys so much. I really appreciate your time, and thank you so much for having me.
Yep, and I appreciate you being with us. Thank you so much, and for the content.
All right, have a good one.
Great, thank you. So I apologize that I did not manage timing very well today. So what I'd like to do now is very briefly, and I think maybe Rep. Lindsay maybe already hit it already, but this concept of corporate. We were going through and having some people review the legislation and the scope of work, and a big question came up in terms of definitions. So if you'll look at the posted agenda, and I can actually also share my screen. Is this it? Yeah. I want to make sure that everybody, and especially Rep. Lindsay and Senator Henriksen, are in agreement that when the word corporate was used, it then referred to a definition for corporation, that we actually mean more than corporation in terms of the legal entity, that we are being inclusive of. I'm gonna have to go to look at something else. I don't know if that went anywhere. I'm hoping I'm not making you dizzy. What do you guys see? Do you guys just see the agenda still?
Yes, we see bullet point 5, discuss concepts of corporate.
Perfect.
And what it really means.
Thank you. That what is intended in this analysis is to look at corporations, limited liability companies, limited liability partnerships, and limited partnerships, that we're being inclusive in terms of the whole ball of wax. So that's maybe the question, because again, that's going to be critical in the scope of work, so that the analyst knows what kind of firms to pull. And then, I mean, I know Rep. Lindsay mentioned today that it's maybe not just corporate. And so then that's the second question. It might be really the idea of quantity. And so there's different ways to analyze the data, and part of our job as your job as the task force is to define a methodology. Is the question more not about the legal entity status? Is it more just the question about quantity? So let's say there's Elizabeth Garner that owns 20 units versus Elizabeth Garner LLC that owns 20 units. What matters? And then the last part of that question is, or does something else matter? Am I missing something in this definition? And what about the idea of trusts? So if it's held in a trust versus held either, whatever it is. So I know I'm asking for maybe, hopefully not a lot, but any feedback on that, and especially maybe from Rep. Lindsay or Senator Henriksen.
I'll chime in quickly that I agree that I think this is changed a little from this concept of corporate or even LLC to the number. And I understand the nuance of an accidental landlord concept, and that is quite different than, to me, in my mind, someone who owns 20 properties. But I think that the difference between accidental landlord with an additional property is quite different than someone who owns 20 properties. And I think I am interested in that aspect. So to me, focusing more on the quantity is helpful to me in determining any kind of policy prescription that could address this, if any, that it is not just a large investor. So that's where I'm at with this after all of the various learning. And obviously, as we have these presentations, there are other aspects of policy that are popping up that could be addressed too. But as far as the original intent of this task force, I think that the focus on the quantity is where I'd like to kind of move things forward for now.
Perfect. Thank you, Andy. Go ahead.
I just maybe have a technical question. I guess if there's pretty prescriptive parameters for the legislative task force, and so if we are saying, hey, maybe the recommendations around corporate housing in there, are we allowed to also say, and then we also have recommendations around LLCs, or I just want to understand the technical side of how the legislative task force, what are the guardrails in which we can make recommendations and cannot.
And I have a question about that too. I've never been on a task force since I've been in the legislature, and I think, like I was saying before, some of what this task force may do, I don't know how much of in this lane we have to stay of like, here's our study on corporate housing, which I think initially it was intended to discuss about large scale investors. So I don't know if we can include in the report, oh, we studied this piece and found that it's this. And also that actually here's this whole other, arena of issues that came up. I don't know, based on how the legislation was written, like how much room we have to discuss other things, or if it has to just be like, these are the numbers. So I'd like some clarification on that as well.
So I can do a little bit of research on that, Rep. Lindsay. I don't know either. But I can talk with our legislative liaison, Bruce Eisenhower, to find out what those parameters are to help inform the task force. I think I maybe saw Senator Henriksen. Did you take yourself off mute?
I did. I'm having some technical difficulties. I think just broadly kind of agreeing to what Representative Lindsay had said, the intent conceptually, as I thought of it when I signed on to this, is once you reach a point of ownership stocks consolidated to where it might be having an impact on the market. And that's obviously a very, very broad definition, and how we actually define the parameters of that. I'm very, very open to differing ideas on that. Certainly I'm not including in that what like we've been talking about, the accidental landlords or those with a small handful of units, but at a certain point where I think when you're starting to consolidate ownership of housing within a market, then it has impacts on that market.
All right. Super. Thank you. So to move forward on that piece, I think I'm going to need to talk with Bruce to understand if we can deviate at all, how we can deviate, or, what that lane is that we can deviate in terms of it. But I think I understand, at least from your direction, Rep. Lindsay, is that when we use the word corporate, we don't it wasn't intended for it just to mean the legal language of corporation, that it meant all of that combined. The intention was LLC, LLP, LP, in terms of firm type, but that there also is this interest in understanding really more the idea of size rather than maybe just how it's owned. Does anybody else have any questions on that? Because then I'm going to just quickly mention two things.
I just have a comment about the scope, but it sounds like that may be coming up, so I can hold that question.
So, yep, that is the next question, would be scope. So is there anything else on that first kind of definitions? All right, scope. I've sent it out now twice to the task force for comments. I received some really good comments from folks, so I appreciate people's efforts to look at it. And it sounds, Teo, that you've got some comments.
Just brief ones, and again, respecting everyone's time. I would just note, high on the list, the legislation speaks to housing availability, and I just wanted to make sure in the scope that it's addressed that housing availability in terms of single family, home buying opportunities for first-time home buyers, but also housing availability for renters seeking single-family home rentals. Because the legislation speaks to vacancy rates, and I know that rental prices is in there, but I think that that's a good kind of holistic way to look at both the different ways in which we think about the term housing availability and the different stakeholders who have interests in there being housing availability, both on the rental side and on the homeownership side.
So, Teo, what I'm going to ask you to do is, if you've just got a couple of words or language and what page or paragraph you would put that in, would be appreciated.
Do you want me to say it, or you want me to email it to you? Whichever is way more to me.
Email.
I'll do that. No problem.
I can't write that fast.
No problem. I do have another quick one, but Cynthia has her hand up, so I'll defer.
Elizabeth, could I email you some additions as well? I won't take up the meeting's time, but I have some edits to offer to the scope.
Perfect. That would be awesome. I would really appreciate it.
Okay, thank you. Back to you, Ted.
I'll follow Cynthia's lead on that. Thank you, Cynthia, or your example.
Super. Thank you, everyone, for that. So what I'm going to do, just in the interest of time, on the last topics for the agenda, one is looking at additional presentation requests. So if anyone has any interest or recommendation on speakers, please send them, and we'll also discuss that more as a task force on how speakers are invited and recommended to speak to the task force. So please, we might have an email conversation about those, but certainly, especially from the housing advocate side, it would be, I know it's hard to maybe find, individuals, right, that have been potentially hurt by not having access to housing. So again, focusing more on the negative side. So looking for speakers on that end, or maybe housing rights, people that could speak on that side on the availability would be helpful. As I mentioned before, we do have an entity, CoreLogic, which is just a data aggregator that kind of scrapes all of the data, puts it together in nice, pretty packages to sell. They've been studying this piece, and so they're going to come in and talk about the data, and just it's going to be a very data-driven component. And the next date of the task force is set for July 31st. I'm also developing the scope for the facilitator, kind of who's going to write all of this and take all of this information and do more of the public outreach component of it. So I'll have that draft together as well by the next meeting. Any last comments by anyone before we sign off for today? Rep. Lindsay, anything that you would like to add before we sign off?
This was a good meeting as far as giving me a lot to think about. And so thank you for pulling together these things. I do have some, I think it is very critical to get this kind of other aspect of these things, and I will be thinking about that as well, of some other things. But I do, I appreciate everyone's time, and just even learning about the different things that are out there is quite helpful to me. So I appreciate that, and I will engage offline in the email, and then I will see you all next month as well.
Super. Thank you so much, Rep. Lindsay, for being with us today. Thank you so much. Also, I don't know if Senator Hendrickson is still on. It looks like he may have dropped. Appreciate him sitting in an airport. So thank everyone for your time today, and please send me or Adam any questions, comments, thoughts, and definitely on the scope of work, because it's being kind of sent to our contract administrator as soon as possible. Great. Happy week, and we'll talk to you guys shortly. Thanks.
Thank you.